Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are talking about, what they're sharing on social media. It's probably going to have some uranium in it because a lot of people are excited about the moves in uranium. I'll give and interject my financial opinions as we go through all that. It's probably going to be related to three topics: wealth building, financial topics, and or commodity related topics. So let's dive in here. Let's see what's going on and what people are sharing in the market. If you want to follow me, it's at funding_finance. And if you want to join our community, finding-value.com. We have a Sunday question and answer session coming up if you guys want to attend, and I can answer your questions. So coming on down, we've got 1976 to 1980 style cycle, higher for longer, ever more likely, supply response too little too late. Well, what I'm going to say in the 1970s, it wasn't really a supply response. That was a lot of credit growth, and the supply was going up quite a bit. I mean, we had inventories during that time frame, and it was a credit-driven boom. From 98 to 2007, that was another credit-driven boom by the real estate market. Both of those times were credit booms in the real estate market. Um, this time around, we are in an expansion phase of real estate, and credit. We'll probably get a credit boom here from real estate, and that's why home builders are up so high. So it's the credit in the system going up and down that caused those previous booms. This boom here, I think we actually have a real shortage. So what the curve will look like isn't necessarily known compared to previous curves that were just credit-driven booms. Think of credit-driven booms as money rotating in the system differently. So we'll see where this boom, the next bull market here in uranium takes us. But it could look very different than both of these previous charts um, of what we've seen previously in history. This person says, gone, gone. All secondary uranium supply from commercially available inventories created in 11 to 17 are gone. Now the solution to the annual primary uranium supply deficit has to actually come from lots of new uranium production. Good luck with that. And that's where my take about this is not higher for longer. Like, what slows the price of this going up? And if you notice both markets, the spot market went up kind of like just straight. It didn't really have any pullbacks. I don't know what's going to occur here. This is going to get real interesting. It's because if there really is a supply shortage and the demand is as inelastic as it is, if there's any type of panic that occurs, who knows where it's going to go? It's going to get real interesting. There will be 8.2 trillion in treasury debt maturing in 2024. This is an all-time high. So liquidity will reemerge as an issue again in 2024 because of all the debt that's going to have to be rolled over and is maturing in 2024. That looks pretty interesting there. Probably more money printing is my guess. Looking good. We've got more uranium here. So the uranium miners did, again, a 580% in its baby bull move. That's the move here that some people refer to it as easy money. But we are in a bullish falling wedge. We've got one, two. It's the right-hand shoulder of URA versus the SPUT uranium trust. And I think we could get a big move here. I don't think people are ready for that. I don't think they have a clue of what to expect of what potentially could be coming. Now, I'm not saying that this is going to be an easy ride. I'm not saying it's going to go straight up. I don't know. I don't think anyone knows what this will exactly look like, but I can tell you this. I like how we're positioned. I like what the futures price is doing, and I like that we are moving down the production chain where the producers are already moving, the developers are starting to move, and then most likely the explorers will move last. And we haven't even seen URA move against the spot price. We'll call it the SPUT price there. But This is pretty cheap. This is pretty cheap here, guys. And I am pretty much in awe that the equities are as cheap as they are versus the commodity price itself. I would say that's even true in some other commodities as well, not just uranium, like gold and silver mining companies, for example. The uranium investment opportunity in two pictures is what this guy says, even though I only see one picture here. Maybe I'll hit show thread. Maybe there's another one. No, there's the other one. So we've got demand, mill capacity, mine supply, and then the big shortage for North America is what he's got. And then down here, we've got USA. We've got no mine supply, basically, not much mill capacity, and a bunch of demand. That is excluding Canada in this one. So this is with Canada, this is without Canada, and you can see the gap that is created here. So that's the problem that we're trying to solve, that shortage or that deficit gap. Uranium thesis is going according to expectations. The price of the commodity is already at the highest levels of more than a decade. Stocks are starting to move. The stocks are starting to move from a very underpriced level. We got a lot of upside left, boys and girls. Now, the game is going to be in your hands. What are you going to do with it? You're going to be patient and wait for this to play out? Or are you going to say, I'm going to sell at $100 a pound, or I'm going to sell when I'm up 100%? Well, that's up to you and what your strategies are. But it looks good to me. Looks good so far. DHT update. So quarter four. So I'm going to go down here and read this. The fourth quarter of 2023, the company estimates time charter equivalent earnings for its fleet at 42,800 per day, comprising of 39,600 per day for the company's VLCCs on time charter and 43,600 per day for the company's VLCCs operating in the spot market. Thus far in the first quarter of 2024, which we just entered, 50% of the available VLCC spot days have been booked at an average rate of 56,300 per day on a discharge to discharge basis. 61% of the available VLCC days, spot and time charter days combined, have been booked at an average rate of 48,900. Wow, that is quite a bit higher than last year of 2023. Go DHT. Microsoft alone is the size of the entire stock market in Canada. Come on, guys. Are you serious with this? Microsoft is the size of the entire stock market in Canada. Just how big have the Magnificent Seven become? The market cap of the Magnificent Seven is now 4 times that of the Russell 2000. Guys, this is ridiculous. This is what a bubble looks like. I have to say that. And the valuations of these big companies, like price to cash flow and all this, they're just stupid expensive. What are we doing here? What are we doing? Speaking of uranium, Camco stock climbs on request for domestic uranium supply, and Tim Seymour says there's no question demand will continue moving CCJ higher. We're in the media phase, boys. Looks pretty dang obvious here. We've got the media phase. We've got both DNN and NXE closed flat for the day after a big move yesterday. This is just a temporary pause. Now, I'm going to pull up a chart of DNN just so you guys can see it. I know some of you guys asked me to pull some of this stuff up. Here's DNN. I'm going to back out. This is some of the charting I do. This rectangle that we've got, there's a lot of resistance in that rectangle there. Obviously, when I chart, we have a downward move. We've got a long basing pattern. And we haven't even really exited the base of this. We're still getting stuck with all this resistance through this gigantic buying, selling pressure. And the 2021 boys that jumped in late are probably selling. But we look fantastic for a move higher. These are just 2 little small down days. It is a continuation pattern, in my opinion, and we'll probably break out of this congestion area and probably start to run. NXE, just so you guys can see, that's not in the same position here. We had a nice little kind of run up here, big consolidation. This is where I got active, was in this region here. Came on up, you've got a big flag pattern, and we're breaking out of that flag pattern. It's already had a pretty big run. DNN is just stuck in some mud, so to speak, with that resistance that it's encountering here recently. The more I hear Kathy Woods talk, the more I am convinced Bitcoin is nothing more than a decentralized Ponzi scheme. um, the easiest thing that I will say is this: take away all of the price depreciation out of Bitcoin. Okay, take that out, and then say, what does Bitcoin actually do outside of the price appreciation crap? And that is what you're going to come up with, is what this guy just said. It's a decentralized Ponzi scheme. It's not good at being a currency. It's not good at doing transactions. It's very energy inefficient. It's slow, etc., etc. So what people do is they say this human man-made thing is going to preserve my wealth, even though nothing in history that has been man-made has really preserved wealth. Usually it's stuff that is in Mother Nature, whether that be gold, silver, which is created by Mother Nature and has intrinsic value, especially silver. Then you've got land that people have. But I don't know. I'm not on that train. I just started laughing when I heard that. Kathy Wood and decentralized Ponzi scheme. I just thought that was very funny. This is a breakdown of epic proportion for the US dollar priced in the Swiss franc. Now, the Swiss franc during commodity booms outperformed the dollar. This is a currency game, guys. So until this objective and unbiased bearish evidence reverses, the trend is down for this ratio. And if this continues lower, I think we're entering that commodity bull market, and we're going to see a lot of commodities start to run big. Not just uranium, it's going to be a combination of a whole bunch of different commodities. Now, could we be early where this breaks out and then it comes back up to do a retest? That is very much possible. Not saying that it's going to go straight down. We could come back and do a retest. That retest would be a slowdown in the market. The dollar could potentially strengthen, maybe, but I doubt it. If interest rates come down, how about this? Interest rates go up for a period of time, the dollar strengthens for a little bit, and then we roll back over where we could see a weakening of the dollar and lowering of interest rates. That could be a potential path. But generally, when you look at this, when we see a breakdown of the dollar versus a lot of other currencies, that is when the commodity bull market starts to it starts to get going. This is a really interesting perspective from the same report on the dual modes of the oil market. Oil prices tend to hover near demand destruction pricing levels or supply destruction pricing levels. The current price is near average for the supply destruction levels. That's true for any commodity. What we can look at is the supply destruction price in relationship to the demand destruction price. And this is looking at history and the price of oil and the two um, normal distribution curves around those prices. We can also use ratios, and ratios will tell us maybe where the tail is on the right-hand side when you take into account inflation, which is gold. Gold's your inflation measurement. It used to back the dollar. That's why I use a lot of stuff against gold, because it was a part of our monetary system. And right now, if we were to do that ratio and look at the top peak of oil, I think oil could go to $250 to $350 a barrel by the end of this bull market. And we're not at the end of the bull market, guys. So I know some people said, "Oh, you said 250 by the end of the bull market." We're not at the end of the bull market. The bull market will probably end when we see housing starts roll over and we have built too many homes and inventory goes up. That's probably going to be end of the 2020s. So we're going to see some blow off top in oil at the end of the 2020s, at the end of wave 5. We're only at the end of wave 2, perhaps. We haven't even started wave 3. So slow down, you guys, on your short term, go chase shiny objects, whatever you guys are doing. Calm down. It depends. 10K passive income is a life changer for 99% of the world population. Harsh truth, 10K per month won't change your life. If you have 10K of passive income, I mean, that covers all my expenses. I'm good. And yeah, I do have that. So, and that's basically what you want to set up for yourself. You want your dividend income to surpass your expenses. And then hopefully your dividend income will continue to grow with time. Coming down, Brady called the top in US yields below, and all said below is now happening. Surprised that this chart did not get more attention, as it will have a massive implications on all markets, plus lays out the roadmap for things to come. And this is your long 40-year downtrend line break. There's the inverted head and shoulders, the break, and then we're probably going to go to step 4.4, and then work our way on up after that. And really what they're going to do is they're going to get inflation going again. They're going to kick it back on with lower yields. And that's going to create a housing bubble. It's going to create a housing bubble when the rates go down. We're going to build a bunch more homes, and then we're going to build too many homes. People are going to go in foreclosure, et cetera, and we'll go in a big bubble. That's my guess. And the big bubble will result in high interest rates at point number 5. Simple yet so valuable. I think this chart will be important over the next decade. There are many financial physical asset charts that show how badly commodity equities have underperformed the S&P 500, or how gold stocks have underperformed precious metals, or other such metrics. Oftentimes, they are mislabeled, saying that resource equities are cheap. That may be the case, but underperformance alone does not indicate cheapness. It also misses the underlying factors that are likely to change the trajectory. That's the market conditions. Outsized investment returns come when two things happen. The initial price paid in terms of valuation for a company is relatively low, and that company experiences a period of improving returns on the capital it invests. The overall level of capital expenditures in any given sector gives clues as to the future returns in that sector, as both overcapitalized and undercapitalized sectors inevitably revert to the mean. High returns attract more capital, which effectively compete down returns as even margin ideas projects move forward. Eventually, capital goes elsewhere, and that capital starvation creates a period of elevated returns as only the best ideas projects get funded. When we initially posted this chart in late 2021, it was our belief that the severe underinvestment in the natural resource sector would lead to a period of outsized returns for the companies in the sector. And given their multi-generational undervaluation, GMO's 100-year valuation versus the S&P, in my humble opinion, is the gold standard for that measure, that the stocks would significantly outperform. Totally agree there. The returns on the underlying businesses have indeed improved, and many resource companies are delivering financial returns, the true free cash flow yields above maintenance capital, that are every bit as good as, and in many cases, superior to, some of the most lauded and highly valued tech companies in the market. That said, the stocks have been just okay. The chart below is through Q3 of 23, and the relative drubbing of resources versus technology in Q4 has this measure back to a pretty close horse race between the two so far. So where do we go to from here? We still believe that an extended window of higher company level returns for natural resource equities has been ushered in, driven by severe underinvestment in new projects, accentuated by ESG mandates, and viewed with total complacency by an investing public that believes the politicians, when they say the energy transition away from fossil fuels will be cheap and easy, should we prove correct, then the current valuation of resource equities in the cheapest 3% over the last 100 years are likely unsustainably low. Improving valuations and accelerating profitability are a powerful combination. Conversely, the surging capital flowing to technology and related companies will inevitably lead to lower returns on their investments, which may prove problematic given their generally lofty valuations. Stagnating earnings at several bellwethers are an indication this is already manifesting itself, and we would expect that to continue over the coming years. To be clear, we see the reality that technology is, in general, an area that experiences significantly superior growth, and that the sector as a whole over time will provide superior returns to commodities. History says they will, and we see no reason that should change. The point we are making is that the inflection points noted below, coming every decade or so, investors have been extremely well compensated for shifting portfolio allocations away from where companies are spending record levels of capex, increasing exposure to sectors where even the companies themselves are choosing to invest less. So this is basically looking at the movements of tech and commodities. Now, I just read through all that. This person, I don't know if they understand what's causing these movements. What's causing these movements is an inflationary move from an expansionary phase of real estate when looking at history. And what's coming right now is an expansion phase of real estate that's going to do the same thing. And I think we're going to see an underperformance of tech and we're going to see an outperformance of commodities. And the market conditions that create that is credit expansion from the real estate market. That's what's going to cause it. There's also other inflationary pressures from fiscal spending that could also add into this mix of increasing interest rate environment. We've also broken that 40-year downtrend in interest rates, the one that we were just looking at up here with Grady, this one. That will cause the rotation of money away from tech and into commodities. Here's oil. Oil's trying to break out of its channel here. 74.50 is the level that he's looking should do the trick if we can break. But we've been stuck trying to base out here in oil here recently. We've got analysts see uranium's third bull market through 2024, and so it begins the media attention phase. Totally agree there. We are right here in the media attention phase, just after the bear trap. And I think we have a big, long way to go higher here. Totally agree there. He is nuts on. The S&P 500 earnings versus oil. A chart trader must always ask himself, where does the chart defined weight of evidence land? You'll have a better chance of properly establishing odds for the next possible outcome the more you look into the past. So SPX earnings per month priced in oil is cheap and is expensive up here. And we're kind of in the middle working our way lower. 2020, I think, is the peak here. And we've been working our way on down. And it looks like we're going to see an outperformance of oil soon versus the S&P 500. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And we'll see you Sunday at 5 p.m. Mountain Standard Time. And for the question and answer session for those that are members. All right, guys. We'll catch you later. This is Finding Value.